Hello and welcome to this update on the fourth quarter of 2022. We're recording this on the 25th of January, so we're trying to bring everything up to date as we can do. As usual, myself and James are here going to talk through what happened over the last quarter and perhaps cover some things what we expect to happen going forward. Once James and I have finished, I'm going to introduce you to Lawrence, who's got some good news on top of the good news which I think you're going to be bringing us for the last quarter. So yes, tell us how the last quarter went, James.
Performance-wise, I think we're very satisfied with how each of the different models delivered their performance. So what I mean by that, it wasn't just about the performance itself, it was the level of volatility and risk that we adopted to deliver the performance. But in absolute terms, all of the models across the suite of the PEG blends were positive for the fourth quarter. You know, it was quite a favourable quarter for both equity and bond markets.
Okay, now let's take all that jargon out of there. Models and blends and that kind of stuff. So what you're saying is in the triangle, no matter where you were in the triangle, everything was positive.
Yeah, absolutely, yes.
And how does that, because most people watching this will have a mix of the standard investments and some of the Attenborough investments up the Attenborough scale. Mm-hmm. How was the performance between Attenborough, if we use that term, and non-Attenborough kind of compared?
What we've noticed in recent times, and what I mean by that probably is the last six to 8 months, the correlation or the relationship between the Attenborough models and the traditional core models is far better today, in my opinion. They are more closely aligned. So somebody that may be, for example, in the Enjoy Attenborough model will be getting a very similar experience to somebody in the core Enjoy model, but obviously having those green and those sustainable biases baked into the portfolio. So that to us is very important.
Why do you think, when we look back, and I know because I've got a lot of my investments, but sure my pension is in Attenborough, if we say, certainly at the top of that triangle, and that was historically over the last year much more volatile, and because the first half of the year, predominantly because of the Ukrainian war, was so negative, and I think most of us, you know, if you took it January through to December, most of us are kind of like down on the year, predominantly because of that first quarter and what happened in Ukraine. Why did we see so much more volatility within the Attenborough scale than the core portfolio, do you think?
Well, I think there are two parts. You're absolutely right. The worst of that storm was really from, I think it was November the 21st last year through till the end of the first quarter 2022. So when I say last year, I suppose I'm talking November 2021 through to the end of first quarter 2022. That was the worst of the sell-off in so-called growth stocks, technology stocks that are typically found within sustainable model portfolios. So we had to weather that storm. But what we did do in the summer, in June, we did rebalance and we did address some of the volatility and the risk within the sustainability models, the Attenborough models, and we undertook a sort of a program to reduce that risk and bring it more into line with the core models. And I think we're now starting to see the fruits of that labour. You know, we are now seeing a greater correlation and in turn less volatility within those Attenborough models than we did witness within the first 6 months of their existence.
Okay, well, that makes sense then. And certainly when I look back, you know, at my own investments, and I'm sure you do with yours, because everybody within the company invests within the same investments, we saw that negative thing for the year as a whole, which, as I say, is down to the first quarter. But actually, when I look at all the markets across the world, whether it's the S&P 500, whether it's the NASDAQ, whether it's China, whether it's Japan, whether it's Germany, everybody was down for the whole year. So is it ever, and this is a question that clients often ask me, in a world where everything's negative, and everything last year was negative, unless you're incredibly lucky, and I feel sorry for all those people that suddenly invested in Tesla at the end of last year, you know, jumping on a horse which is going in one direction doesn't necessarily mean it's going to keep going in that direction. Is it ever possible to have a positive return in a world where everything's negative?
Well, the answer is no. There were sort of two positives out of the whole sort of spectrum of investable assets last year. One was cash, but of course in real terms versus inflation it was still negative, but cash would have delivered about 1%. And then really the only subsector of the investable universe that would have been positive would have been commodities or the energy sector within the S&P 500, say, or the FTSE. And it's very unlikely any one of our models or our peer group models would have been significantly overweight that sector as a theme, because it would have carried a lot of sort of single sector risk. And therefore, for that reason, within a multi-asset portfolio, I would say broadly, most, if not every investor would have witnessed negative returns last calendar year.
So basically, unless you invested in BP and Shell and that kind of stuff, or, you know, when there's a war, what goes up? Well, people make arms and that kind of stuff. So if you'd invested in armament companies, all that kind of stuff, you probably would have done if that was where you want to do it, but that's highly unlikely, yeah.
Correct.
Okay.
Yeah.
So if we look back over the last 6 months or so, talk to me about how the performance has been in each corner of the triangle, and also talk to me about how that compares to our competitors, because at the end of the day, if we can't beat our competitors, no one's going to continue to invest with us. And the fact that we beat them consistently over the last 25 years doesn't always help, you know, for that one 6 month or 12-month period. So what's happened over the last 6 months?
Well, you know, the committee is very satisfied with the performance over the last 6 months, because not only have we outperformed our peer group as measured by the benchmark, the PIMFA benchmark, we've also been able to deliver absolute returns. So we've made sort of real money for clients, and we've been able to deliver that performance with lower volatility than the benchmark, than the peer group as well. So that's satisfying. As you know, it's not only about the performance we deliver, it's about the journey of that delivery. You know, how much risk and volatility are we accepting in order to achieve our objective? So to do that and hit our objective with less than half the vol of the market is satisfying.
Okay, so let's perhaps take a look at that in chart forms. So if you take a look at the chart that's in front of you now, what we're seeing here is in the bottom left-hand corner of the triangle, which is protect. And so talk us through that. You can see that the blues are your performance, and the red is kind of like the average of everybody else. When you're saying, you know, you can see we're positive where everybody else, the average of everybody else is negative, but also there's a lot less volatility, that the line doesn't dip as much. Why do you think we've managed to beat everybody else so much there? You look at that big gap, you know, halfway through, you know, 3 months ago, everyone's way behind us. What was the reason for that? What's the reason for that fall?
Certainly with Protect in mind, the biggest driver of that outperformance would have been from the fixed income or the bond element of the portfolio, where we had a very conservative positioning. So we were shorter duration in nature, and we've spoken about duration and maturity in the past. The lower the duration, typically the lower risk. And we had a very cautious outlook, and that helped us to defend the worst of the sell-off witnessed by markets. And in many ways, our mantra is, if we don't give up as much in a down market, then we don't have to work so hard when it goes back up. Of course, we work equally as hard, but we don't have to over-egg the model or accept undue risk to make back the gains that we gave up. And it's about compounding those returns. Don't give up as much in a downward market and then capture the upward market. It's very powerful over time.
So again, this is continual focus on above average performance and below average volatility.
Yeah.
That's what we're doing. Okay, so let's perhaps take a look at the bottom right-hand side of the triangle as you look at, which is those people that want to enjoy their portfolios. Typically, they're taking an income from them, so generally they want less volatility than perhaps the top of the triangle. So if you look at this chart in front of you here, what does this show us, James?
Well, it's a similar story, but maybe with not such significant outperformance, but there is outperformance still of sort of 2.5% or so versus the peer group. But again, it's very satisfying to see that we're actually up 2.7%, give or take, over the last 6 months. So we're really sort of working hard to make sure that the pain that was witnessed by some investors throughout 2022 is eroded as quickly as possible as we go through this slightly more sort of fertile backdrop, if you like, of markets. So we're able to capture as much upside as possible without taking on undue risk.
Okay. And then if we look at the top of the triangle, again, what's the story there if we look at this chart?
Yeah, you can see that the volatility is slightly greater at the top end of the spectrum, top end of the triangle. You know, investors typically within the grow portfolio are more willing to accept greater volatility. But what has been satisfying since the market sort of troughed around the 10th or 11th of October, I think the model is up something like 11 or 12%. So really the message with Grow is, you know, being in the markets is just so important. You know, what we've spoken about before, the importance of not panicking at the wrong point in the cycle and crystallizing losses. You know, when the market was troughing in early October, the natural sort of emotion would have been to have gone to cash, sell my portfolio, hold cash in the bank. But actually fundamentally, that would have been the wrong decision. And investors have been rewarded for accepting the volatility, and thankfully we're coming out of the other side now.
Okay, so from those charts and certainly what we can see there, the last 6 months has been very, very positive. everyone's in positive territory. We're beating the averages. Now I'm going to ask you to put your crystal ball in place there now. So what has the next 6 months got hold for us?
So personally, I'm quite excited about the next 6 months. The great thing about our investment committee, it's made up of 5 very experienced individuals, and nobody holds any punches. And there are some on the committee who are far more bearish. They're more sceptical on the short-term direction of markets, and there are some of us that are a little bit more optimistic. But that's what makes a really good committee, is that discussion and that debate. There are 2 drivers in many ways that move a market. One are the technicals, the valuation of the market. I believe that they are relatively positive. The market doesn't look unduly expensive, and the really exciting thing to us as multi-asset investors is we can now get yield on our bond portfolio circa 4%. Government bonds yielding 3.5-4%, which is something that we haven't been able to say for a number of years. So there's great valuation opportunity now within the bonds as well as the equity potentially. But the other driving force behind the direction of travel for markets will be the fundamentals. So what's going on in the economy? That is still quite opaque. But at least we have a positive view on the valuation, give or take, versus a less positive or neutral view on the fundamentals, what is going on in the global economy. So we have one positive and one neutral/negative. Actually, that's not a bad marriage. That means that we're going into 2023 with a relatively fair valuation or sort of appraisal of the markets. And I would say we're going into 2023 with a much more optimistic lens on than we would have been going into 2022 based on the technicals and the valuation of markets.
Okay, so if I can perhaps unwrap that a little bit, you're talking about, you can get decent yields on stuff. So am I right in thinking if you're on that bottom left-hand corner where you're trying to protect your money, which is where we don't have very many equities, it's mostly government gilts, loans to the government, loans to companies, that kind of thing. Are you saying that because there's been an increase in interest rates, effectively, we're just getting a higher return on that stuff, which 2 years ago there was no return on?
Yeah, on a straight line basis, we've stood still in terms of the asset allocation, but all of a sudden we're being paid about 3.5 to 4% on that bond element. 12 months ago, we were being paid probably less than 1%. So the return potential has changed, even though the risk characteristics or the asset allocation of the portfolio has remained relatively static.
So if people in the triangle, if they have any of that bottom corner, as you look at it, that would be the bottom left-hand corner, and lots of people do, if they're over that side, effectively they're going to get returns where previously there were none. Does that then mean that achieving better returns with lower volatility is an easier thing to do this year?
It's hard to answer that, because if I say yes and we don't deliver, then I'll be. But joking aside, it should be an easier year than last year based on what you've just said. Does it mean that we have a better chance of outperforming our peer group? No, not necessarily, because we're all in this together. We've all got the same sort of palette of colours to paint from. But actually, in terms of making absolute returns, yes, you're right.
Okay. Oh, excellent. That's what I like to hear. So let me ask you this question just to finish with before I bring Lawrence on. Inflation is pretty high at the moment, whatever it is, 8, 9, 10, 11, 12%. Certainly everything that we believe, and certainly what our economists are saying, is that that's going to be falling over the next 6 months as things like post-COVID demand starts to drop off, post-COVID supply chains resolve themselves. We expect inflation to come down significantly during the course of the next 6 months. And let's say, and we don't know, but let's say in 6, 9 months, so inflation starts to steady itself at somewhere between 4 and 6%, that kind of area, which I guess that's what most of us are thinking. Do you think then that it's likely that with everything you can see that there's a chance not just of positive absolute return, but real returns this year over and above inflation? Because unless we get more than inflation, everybody's going backwards.
Yeah, exactly that. If we do get inflation sort of coming down towards sort of mid-single digits rather than high single digits, clearly we've got a much better chance of delivering real returns. And that's obviously the objective of the model portfolios in which our clients invest in. Our view is that inflation has peaked, it is rolling over, that's what the data suggests. Whether it rolls over and comes back down towards 2% as quickly as some are forecasting, I think the jury's still out. I think we're probably going to stay slightly higher for longer, but that doesn't mean 9-10%. It might just be in that 4 to 6 territory. But of course, as far as markets are concerned, in some ways it's not the level of inflation that scares markets, it's the rate of change. So how quickly is inflation going up or down? Because markets struggle to price in that rate of change. So as long as we have visibility on where inflation is going to be in the short to medium term, I think that's a great sort of platform from which markets and bond markets can deliver performance.
Excellent, thank you very much. Okay, so at long last we're starting to have some positive news all round, and looking forward to, fingers crossed, a more positive year, certainly from an investment point of view. But what I want to do now is I'd like to bring on Lawrence Patrick. And Lawrence works with the Trust DFM team. And Lawrence, you're going to share with us some really good news when it comes to the advantages of the fact, because Trust DFM is managing more money because more IFAs are getting involved with us. That means because there's more money, there's some real benefits of that. So perhaps can you share that with us?
Absolutely. So since James started with us as the Chief Investment Officer earlier last year, our job at Trust DFM wasn't just to deliver performance for our clients, above average performance as well as below average volatility, but we also wanted to make the portfolios as efficient as possible for our clients, so we can deliver for every single pound they invest with us more and as much as we can. So as you can see in this chart that I put together, the reductions between 12 months ago where the portfolios were and where they are now are considerable, especially on the core range of the portfolios. So in growth, for instance, we went from about 0.92% to now at 0.38%, so that's a reduction of 60%. And you can also see in balance, for instance, which is a mix of the protect, the enjoy and the grow, that is now reduced by 47% as an example.
So what we're saying here then is, again, if we put the chart back up for a moment, is because the company's managing more money, when we go to different companies, whoever they are, and we're going to buy their investments, we've been able to negotiate better fees and lower fees than if a client went directly, or indeed perhaps as other fund managers would do. And so what we're doing is we're passing all those reductions on to the client. So again, in that chart, what you're saying is if you were top that corner, your investment fees are 60% lower than this time last year. In a time when inflation's, everything's going up, we're actually reducing it.
That is indeed good news.
Okay. Tell me how that story carries forward to people that are in the Attenborough sort of triangle.
So in the Attenborough, because the funds that we select in that range of portfolios are more active, even though we managed to get preferential rates on two of the funds there, which other DFMs might not be able to get, we weren't able to reduce them by that much, by as much as in the core portfolio, but still in Joy, for instance, we managed to reduce them by 12%. In balance, 6%. So for an average client that has money invested in a balanced portfolio, the fees are now 6% less than 12 months ago.
Okay, well that is excellent news. And one thing which I found, and one thing I really didn't realise, is that we have a policy of always passing on those discounts to clients. That's one of the fundamental tenets of the company, is when we can get fees down, let's pass them on to the clients. But that doesn't seem to be the same across other discretionary fund managers, and certainly it seems to be very unusual. In fact, I've not been able to find anybody that is doing the same. And coincidentally, I was doing some work with a client in December, and this chap came in with an old Standard Life pension. Standard Life managed a lot of money, upwards of 40 billion, what have you, and they were buying some of the same investments we are. And what's interesting, if you look at what Standard Life are charging clients, what we're charging clients, so if you just take a look at this chart for a moment, you can see one of the funds that they're buying for their clients, as we do, is the Vanguard FTSE Fund. And they're charging the clients over 1% for that, whereas we're charging clients 0.14, 0.13, these really, really low figures. So effectively what I can see is that Standard Life are keeping the margin.
They are indeed, and we're passing all those benefits on to our clients.
Yeah, and interesting, a client said to me, well, why is it that Standard Life don't tell me that? Well, they don't have to. It's just one of these curious kind of like little rules. They don't have to tell you what the margin is. You go back to that chart and you look at the M&G Global Fund that we've got there. Again, they're charging a huge amount, like 1.6, 1.7, depending on what the client is. and we're charging significantly less than that, less than half of that. And so, I'm going to thank you, because I know I'm a client of Trust DFM, so I get these low fees as well. And obviously going to thank James for that as well, because it's only through that negotiation which actually brings things down. And as James said to me a while back, he said, you can't always do much about the market, but where you can perhaps do things and perhaps driving fees down, then it's really important, because you can always guarantee what the fee is. And so if the fee's lower, every pound that you reduce the fees by is another pound in your pocket. So, thanks very much for doing a great job on that. Karen doing that, and obviously post my thanks on to James and the Karen team again. So there we are. So that's the first quarter, the last quarter of last year, recorded it in the first quarter. Let's hope that this year is a much more positive year than last. It certainly seems that way. We'll come back to you probably in April, but if anything happens in the meantime that we think you need to know about, we'll come back to you sooner. So thanks very much for watching.